Hello friends, we completed directive number 2 up to loan restructuring or rescheduling among previous videos, and now let's move to next provision, that is provision of loan loss provision, which is point number 9, and it goes like provision to be maintained for loan loss. And the very first is for the loans and bills purchased classified according to these directives, the following loan loss provisions shall be maintained based on the remaining amount of principal. For good loan 1.10%, watch list 5%, substandard 25%, doubtful 50%, and bad 100%. Next is for any loan classified as inactive, that means non-performing, excluding restructuring and rescheduling, if the overdue outstanding amount is paid and the installments or interest are regularized, it should be classified under the watch list category for up to 6 months, after which it can be upgraded to the good category, and the same loan loss provision should be maintained. If the installments and interest of loan classified in the inactive category are partially paid and remain within the inactive category, they can be upgraded within the same category and the loan loss provision can be maintained accordingly. Similarly, if an institution has taken loans under more than one heading and any loan is classified as non-performing category, then all other outstanding loans of the debtor which are classified as performing must be classified at least in the watch list category. If an individual has taken loans under more than one heading and any one is classified as a non-performing category, then all other outstanding loans of debtor which are classified as performing must be classified at least in the watch list category. If a loan taken by any borrower within a group is classified as non-performing, the analysis of the impact on other borrowers in the group with business relations to that borrower must be conducted. Other borrowers directly affected by that borrower should also be classified in the same non-performing category. Next is, it is possible to maintain a normal loan loss provision of 1.10% in the final year by proportionately provisioning for loan losses each year during the grace period for good loans disbursed to projects relating to energy and other infrastructure construction with a grace period of more than 1 year. For agricultural cultivation such as silk, jute, cotton, and for commercial cultivation of fruits like mango, orange, junar, pear, kiwi, dragon fruit, lemon, lychee, and avocado, a provision can be made for ordinary loan loss reserves at 0.2% for the first year, 0.6% for the second year, and 1.10% from the third year onwards. Now next, and the important one, in the case of restructure or reschedule loans, a provision for loan loss must be maintained as follows. A number, for loans classified as performing at the time of restructuring and or rescheduling, a minimum of 12.5% loan loss provision must be made if all the following conditions are met during the restructuring or rescheduling. And the conditions are: when restructuring and or rescheduling is done for the first time, when restructuring or rescheduling is done to be repaid in equal installments, when restructuring or rescheduling is done with a grace period of up to 1 year. Now, point number B, during the time of restructuring and or rescheduling, for loans being classified in the performing category other than the cases mentioned in point A above, a minimum of 25% loan loss provision must be made if they are restructured or rescheduled. Loans that have already been classified as substandard, doubtful, or bad must maintain the previously established loan loss provision upon restructuring and rescheduling. No adjustments can be made to the loan loss provision maintained for restructured and rescheduled loans unless the loans remain regular for 2 consecutive years. Next is, in the case of loans provided on an installment basis or on an equal monthly installment scheme, as long as the principal and interest of the loan remains regular, there will be no need to maintain an additional loan loss provision akin to restructuring and rescheduling of such loans as mentioned below. If the amount and number of installments decrease due to prepayment of loan installments, if the loan tenure and installment amount change due to the fluctuation of interest rate on loans with variable interest rate. In this context, if the interest rate increases and the loan tenure and number of installments are extended, the installment amount determined at the time of loan approval cannot be reduced. Similarly, if the interest rate decreases and the loan tenure and number of installments decrease, the installment amount determined at the time of loan approval cannot be reduced either. Now, loans that have been restructured and or rescheduled can be converted into pass loans if the principal installments and interest payment are made regularly for 2 consecutive years after the grace period has ended. Next, for borrowers who are unable to repay the loan within the initially designated repayment schedule due to reasons such as ensured expansion of the production capacity of projects financed by bank and finance institution, increase in investment or other cost increases, and these projects are in the national priority sectors like hydropower, cable car, cement, star hotels or other infrastructure related products, the following conditions must be fulfilled for restructuring and rescheduling, allowing only 1.1% loan loss provisions, and such restructured or rescheduled loans can be classified as pass loans. The conditions are: the project must not be inactive but in operation or in the process of starting operation. The interest accrued after the period defined as the grace moratorium period at the time of initial loan disbursement shall not be capitalized as income. Banks and finance institutions must ensure the expansion of the project's production capacity. Next point is, if banks and finance institutions need to restructure or reschedule loans given for poultry farming due to the inability to repay according to the original payment schedule or terms because of bird flu, they may restructure or reschedule the loan once based on a written repayment plan from the debtor, the adequacy of collateral security, and the capacity to repay the loan in future. In such cases, only a 1.10% loan loss provision can be maintained. Next is, loans provided against the collateral of shares cannot be restructured or rescheduled. When restructuring or rescheduling loans in accordance with the procedure concerning facilities that may be extended from the financial sector regarding sick industries issued by this bank for the rehabilitation of or suitable exit of sick industries published in the Nepal Gazette by Government of Nepal 2013 Procedure 2.1, a minimum of 25% loan loss provision must be maintained. Now, licensed bank and finance institutions are required to make a loan loss provision of only 25% for loans secured or insured by the Deposit and Credit Guarantee Fund, receiving a 75% discount on such secure loans. Next, when providing loans against personal and institutional guarantees, it is mandatory to obtain details of assets equivalent to the personal guarantee amount that are not subject to any other claims. Loans disbursed solely on personal and institutional guarantees should also be classified accordingly as pass, watch list, substandard and doubtful. For loans that fall into these categories, an additional 20% provision for loan loss must be maintained on top of the percentage allocated for each category. In cases where movable or immovable assets and project collaterals are insufficient, an additional security through personal or institutional guarantees is obtained, An extra 20% provision for loan loss must also be made on unsecured loan. However, the following loans disbursed against personal institutional guarantees are not required to maintain the additional loan loss provision. They are A. Credit card loans. B. Loans provided to the institutions mentioned in section B of point number 5 of directive number 3, which is Nepal Oil Corporation Limited, Nepal Food Corporation, Agricultural Inputs Company Limited, Sole Trading Corporation Limited. C. Banks and financial institutions will not be required to make an additional 20% loan loss provision as specified in subsection 5 on loans issued for education guaranteed by personal collateral, loans issued with project collateral, and loans invested under poor class lending to microfinance and cooperative institutions. D. Loans up to NPR 2.5 million provided to institutions offering technical and vocational training. Similarly, E. Provision of personal loans up to Nepalese rupees 1.5 million subject to the following conditions. The lending policy of the licensed institution must clearly specify the disbursement, monitoring and recovery related to such loans. For the disbursement of such loans, a separate product paper must be authorized and implemented by the board of directors of the licensed institution. Then the product paper must be fully compiled with during the loan disbursement. There must be a clear basis for the source of the borrower's income to cover the loan repayment. Such a source of income must be verified through the bank and finance institution account of the borrower. Additionally, the borrower must mandatorily have a permanent account number. And the repayment schedule must be fixed in such a way that the loan is repaid in equal monthly installment (EMI). The maximum tenure for such a loan shall be only up to 7 years. However, the licensed institution may choose to provide an overdraft loan up to a maximum of NPR 500,000 within the limit of NPR 1.5 million. Loans provided to professional entrepreneurs engaged in the various professions affected by COVID-19 by the end of March 2079. Now this doesn't matter. Such loans cannot exceed more than 5% of total loan portfolio. F. Loans disbursed as collateral for projects up to 50 million. G. Loans under clauses A and G must be classified as non-performing if overdue by more than 90 days and 100% loan loss provision must be maintained. As separate details of such loans must be prepared. Now next point. Licensed institution must classify loans only provided on third-party collateral into the categories of pass, watch list, substandard and doubtful, excluding the specified cases below, and maintain an additional 20% loan loss provision besides the percentage set for that category. In cases where loans are secured not only by the borrower's assets but also by third-party collateral, additional loan loss provision as outlined above must be made for the portion not covered by the borrower's assets. Separate details of such loans must be prepared, and the specified cases are collateral held in the name of a family member in the immediate household of an indebted individual, collateral held in the name of the proprietor, partner or a member of the immediate household of the firm, loans provided to secure leased property as per agreements for the operation of commercial agriculture, industry and other businesses through land consolidation or contract. However, in the case of term loans disbursed before 2069-329, it shall not be mandatory to make such additional loan loss provision until the period for payment of the final installment. A licensed institution can classify loans in a lower category if it analyzes that an economic downturn on any other regions has diminished the borrower's ability to repay. For example, substandard loans can be classified as doubtful or bad loans, and doubtful loans can be classified as bad loans. If a licensed institution wishes to establish additional loan loss provisions beyond the minimum specified in this directive by reviewing its loan status, it must clearly disclose the accounts with additional provisions. Loans or borrowing should also include bills purchases and discounts.